James Eng, how are you doing today?
I'm doing great. Thanks for having me.
Hey, I appreciate you being here with us today and taking the time out of your day and sharing your experiences with us. Can you tell us a little bit about your background and how you even got started into real estate?
Sure. So I was actually born and raised in Houston. Went to high school at sort of Memorial High School, West Houston. Went to UT Austin there in Austin and did finance. And essentially from UT Austin, I got into G Capital. So I did their finance rotational program. And one of their rotations was actually in commercial real estate. So I spent 8 years as a loan underwriter, really looking at balance sheet deals for GE Capital. So we were loaning our own money into deals, and most of them were sort of 25 million and up, industrial, office, retail, multifamily across the U.S. And so, as a loan underwriter, you look at not only the property, but you look at the borrower financials. And so, for 8 years, I saw how guys made a ton of money in real estate, and so I said I really need to be on the investor side of the equation. So I started investing in multifamily about 3 years or 4 years ago now, and I'm in about 13 deals now as a just as a passive in multifamily deals. So
Okay, awesome. That's a great background. How many units is that? Those 13 deals,
13, it's about 3,300 units. So it's
3,300 units. Man, that's
yeah,
a pretty
3,300 units.
pretty big
Yeah.
size. Yeah, and so just an odd question. Why haven't you decided to go over to the GP side? You're is it because you're doing so well and has a limited partner? I mean, what is the reason for that?
Yeah, I mean, I think you can jump over to the GP side at some point. Right now, my focus is on originating loans and helping investors, originate new debt and assume loans or do supplementals. And so last year I did about 40 transactions, originating about 200 million in debt. So, that sort of builds capital for me to invest and also allows me to sort of have inside information on a lot of transactions. And so I think as I get a little bit more experience and maybe that GP is in me, but right now I don't really want to compete versus a lot of the clients that I have right now. And so I just I stay on the LP side of the table.
Hey, that works just as well too, right? So,
Yeah.
we always say, so why fix something that's not broken? I mean, it's working for you, so keep at it. Yeah.
Yeah.
So, what kind of loan products do you guys provide, and what are the loan sizes, and kind of touch on that a little bit?
Sure. So most people who are getting in the multifamily on their first deal, they're really looking at probably like a recourse bank loan. And so we do those. Those are 75% loan to value, 5-year fixed deals at probably about 5% right now. And then as you grow in size, so anywhere from a million up to, let's say, 20 million is sort of our target deal size. So that it could buy you, 50 units all the way up to 200, 250 units. And that's going to be more in your Fannie or Freddie box. And so those, like Fannie Mae, you can do up to 80% loan to cost. You can do 10-year fixed. You can get anywhere from 1 up to 5 years interest only. And then, I mean, you're probably looking at, about 5% right now on Fannie Mae. And then Freddie Mac, they're usually going to be 1 to 6 million on their small balance side. And that's similar terms, so you can fix it for up to 10 years, and then it's 30-year amortization after that. So they also can do anywhere from 1 to 3 years interest only. So a lot of people when they call us, I really walk them through sort of three questions. Number one, sort of what's the occupancy of the property, and that's going to determine whether it qualifies for Fannie or Freddie. And then second is sort of your experience. And then third is what your net worth and liquidity is. And so once you have those three things figured out, that sort of narrows down what loan options are available for you based on the property's performance and then your sponsorship group's experience.
Okay, great. So you mentioned it was based on the occupancy, it's based on the investor and the net worth. So what are the specifics on those numbers? What do you look for to be able to proceed with the loan?
Sure. So let's say you want to go buy a $5 million property. The loan is $4 million, so 80% of the purchase price. The sponsorship group would need a net worth equal to or greater than the loan amount, so $4 million or higher. And then they need 10% of liquidity, 10% of the loan amount in liquidity, so $400,000 in post-close liquidity. So that's after the $1 million down payment. The key principals or the sponsorship group need $400,000 in bank statements in cash or marketable securities. So that can be a limiting factor as well as net worth on your loan. And then on the experience side, they're really looking for, on Fannie Mae, they really want you to have signed on a loan, so be a loan guarantor on a Fannie Mae loan of similar size. And so, $5 million deal, let's say in Dallas, is 75, 80 units. They want you to have signed on a loan of that size. And then Freddie Mac, especially on the small balance side, they're a little bit more flexible on that. As long as you have third-party property management and you qualify from a net worth and liquidity standpoint, then they're okay with you having limited experience.
Got it. And what is the occupancy that you're looking for to be able to qualify for a Fannie Mae, Freddie Mac type of debt?
They want 90% occupied for the last 90 days. So Freddie Mac, they usually look at the average of the last 3 months. And Fannie Mae, they're a little bit more flexible on that, but essentially they want an upward trend. So they want that 90%, but it going upward as well.
Going upward, okay. So what happens if we're at 89% or 88% where we don't qualify? We're just under that. Then what's the situation there?
So Fannie Mae, you can go in for what's called a waiver and get a waiver on it, and I've seen exceptions go down to about 85%. But on Freddie Mac, they've been pretty strict on that 90%. So that average of the last 3 months needs to be 90. So I mean, that's a risk. In today's market, maybe 5 years ago, 4 years ago, there was not as much hard money going, earnest money day one that is going non-refundable. But in today's market, there's a lot of money going hard day one.
Yeah, right.
And that's creating a situation where if the seller stops pushing occupancy, stops pushing leasing, then your occupancy could drop below 90. And so that's a real issue, especially for some of these smaller properties where, it's 50 units, just 2 or 3 people moving out,
Yeah. Put you in the red.
in December or January. Yeah, December or January, and you're in trouble. So be very careful about that.
Yeah, great points. So tell me about a bridge loan, and at what point do we have to actually use a bridge loan?
Yeah, so we usually start and say, all right, can it qualify for Fannie or Freddie? If it can't qualify Fannie or Freddie because of occupancy, or if there's some sort of environmental issue on the property or some recent crime on the property, it doesn't qualify for Fannie or Freddie, then we're going to be looking at a bridge loan at that point. So let's say it's 75% occupied, needs $10,000 a door in rehab, then that's when we'd be looking at the bridge loan. And bridge loans sort of under $5 million are going to be your recourse bridge loans. So that's going to be, you are personally guaranteed on the loan, and you're going to be looking probably at 5-year fixed at 5%, 5.25, and you're going to get 1 year interest only and probably 25-year amortization, and even sometimes 20-year amortization. So that's a really standard bank loan. When you get over $5 million on a bridge loan, there's non-recourse bridge loans available, but those are typically higher interest rate and shorter term. So they're typically like 2 years, interest only, but it's probably 6% all in rate, and it's floating. So for those 2 years, it's going to be moving up and down, and in this environment, typically up. So you could start at 6%, but you could finish at 8% in 2 years. But the plan is really, with those bridge loans, to get in, do the rehab, get the occupancy up, and either sell the asset or refinance to Fannie or Freddie as soon as possible.
Got it. What markets do you guys service? You mentioned bridge, Fannie, Freddie, use all these. What markets are you generally serving more than others?
So we definitely do a lot in Texas. I'm based in DFW, but we have people who focus in on Austin, San Antonio, and Houston. But for Fannie and Freddie, we can do loans across the U.S. And for the recourse bank loans, it's really Texas based.
Texas based only. So you kind of stay here for the recourse loans.
Yeah.
And for those of the guys that don't know the difference between recourse and non-recourse, can you go over there really quick?
Sure. I mean, recourse essentially means that the lender, if they foreclose, can come after you personally for any deficit. So let's go back to that example of a $5 million deal. Let's say you get a $4 million recourse loan, and for whatever reason, the property drops from $5 million value to $3 million. Then you still owe $4 million on the loan, and they foreclose on you. That $1 million deficit you are personally responsible for. So any loan guarantors, they can come after you personally to your balance sheet to pull that money out. So if you have cash or marketable securities, they could come after that to make you pay that debt that you owe. Versus if you do a non-recourse Fannie or Freddie, that $4 million loan, once you give back the property, they cannot come after you personally anymore after that. So most people obviously prefer non-recourse, but with non-recourse comes, more paperwork and, tighter controls around the loan process. And so Fannie Mae or Freddie Mac loan typically takes anywhere from 45 to 60 days, whereas a recourse bank loan can close in about 30 days.
Got it. So if a new investor came to you and wanted to get a loan on a multifamily property that they're getting under contract or they're interested in, what can they do to make the process go so much smoother for you guys from beginning to end? What can they do to prepare and have it go smooth?
Yep. So on the very beginning, front end of the process, we ask you, like the key questions in terms of, are you a U.S. citizen? Do you have any prior litigation or bankruptcy? So we try to knock out anything that would come up in like a credit report or, any of those types of searches, litigation searches. That's number one. The second thing is for the borrower to have a personal financial statement and a scheduled real estate already created, and then also a multifamily resume. So those three things are sort of like your basic things as a borrower that you should have. And typically you need that stuff just to submit an LOI, just so a listing broker can take you seriously. And on the property side, you really want to have your year one budget and then also your rehab budget. So those two things are the key things in that regard.
Okay, so they have to make sure that they get their budgets in line before they go and proceed any further. But you're able to start the process, right? At what point do they start the process with you, though? Can they contact you at the very beginning before they have a property on the contract, or they have to have the property ready to go and identify a property before they come in contact with you?
So most people will reach out to us and review their personal financial statement and schedule of real estate up front, so we can answer any questions and sort of qualify them for a specific loan amount. And then once they've done that, then when they start looking at properties, we'll provide a term sheet to them that shows the terms based on that property's performance. So if you send me a rent roll and a trailing 12 financial, we'll take that and determine, all right, is it best to go Fannie Mae, Freddie Mac, or Bridge? And then send you a term sheet so you can present that with your LOI to the listing broker. And it shows that you're actually serious and have your ducks in a row so that the listing broker takes you seriously and you have a chance at actually winning the deal.
Yeah. So I know, the process can take, it varies basically. It can vary from, 60 days, it can be longer than that, 90 days, or it just depends, right, on the different situations that we're in. What can a borrower do during the process to make it go smoother for you and to make it a quicker transaction?
I mean, really, I like to think of sort of the mortgage broker as sort of like the quarterback in the transaction, and just making sure that everybody's in the right spot at the right time. And so you, as sort of the general partner, really just need to be responsive and there's going to be a lot of different things that come up, right? So, you're going to have to get the loan application done. You're going to have to do, the loan application fee. You're going to send the wire in on that. You're going to have a webinar and, speak with your general partners and raise the equity and get your legal counsel engaged. So there's a large checklist of things to do. And, my recommendation is for the next 60 days, don't go anywhere. So some people like plan vacations and go to Europe and things like that, and that makes it more difficult.
Yeah.
But if you do have to go to Europe, go the first 30 days because we need you back here for the
We
second
need you to
30 days.
sign.
So
We need you to
yeah,
sign
we
down
need
the
you to
line.
sign. But we have signed documents all over the place and FedEx it everywhere, so you can sign loan documents anywhere and FedEx it back, and we can make it happen. So pretty much the main thing is just be responsive and take direction well in terms of the number of things that are going on, and constantly just be on top of your legal team, insurance team, and we'll get it there. So
Got it. And assuming that everything goes well, right? There's proper communication. The guy didn't go to Europe, like you mentioned earlier.
yeah.
Everything's good, right? What is a typical transaction take, like from the point of contact with you to the closing date? If assuming everything goes well, what is it? What's the timeline there?
Typically, yeah. So once we submit the loan application, so most people, let's say you get under contract today, that's sort of day one, and you have until day 60 to close, right? So in that first week, most buyers are going to do all their physical due diligence. So you'll have, your inspector on the property, you'll have, somebody on the roof, somebody like an electrician on the property, check all those things. And then you'll typically get all your due diligence in that first week from the seller. So after you've reviewed walked the units, reviewed all the seller due diligence, if everything is sort of a thumbs up and we're ready to move forward, then that's when we would submit the loan application. So let's say day 5, we submit the loan application. Then you essentially have 55 days to close, and Fannie and Freddie take about 45 to 50. So you don't give, when these closing timelines are so compressed right now, 60 days, like you're going to be engaged for 60 days. So that's sort of the timeline for getting the deal started, though.
Okay, great. Have you ever had anybody come to you after they engaged another broker? Have you ever had somebody come to you and where you were able to help them out in the situation and move forward with it? Where
Yes,
the other one couldn't, they couldn't proceed for one reason or another, and they were stuck.
Yeah. So sometimes we'll run into a case where, let's say the seller has a mortgage broker, and they're saying the seller is pushing another mortgage broker onto the buyer, and we've had that a couple of times just in the last 6 months. And one instance, we reviewed the deal and said, this is not going to work for Fannie, it's not going to work for Freddie. It really needs a bridge loan. And they heard from another mortgage broker that this will work, Freddie Mac. And so they took it down the road, essentially spent 60 days with another mortgage broker. And then Freddie Mac came back and declined the deal.
Oh my.
And so they were already, 20, 30,000 deep in third-party reports. And then they essentially had one more extension, and they had 20 days left. And then they called me, and I was like, "Oh, congratulations on closing. I thought the deal was done, right?" And they're like, "No, not exactly. Freddie Mac came back, declined the deal, and we need to close in 20 days. Do you still have a bridge loan option available?" And so I called, a couple local banks here that we do a lot of business with, and said, here's the third party reports, here's the sponsors, PFS and multifamily experience, all that. And then we essentially got approval in about a week, and then we closed at the end of the month. And so
Awesome.
it was just, sometimes it's, I try to win every deal, right? But if I don't think I can do the deal the way that the borrower is requesting, I'm not going to take them down the line and, waste their 30,000 in 60 days, right? Because they have earnest money at risk. So I want to make sure that the deal that I quote, you can actually close. And so to add injury to insult, on this deal, so we closed the deal. This was back in like October or November of 17. And then I got a call from the borrower, who's here in Dallas, and they said, that Freddie Mac lender actually just called them and they want another 20,000 for legal fees. So
Wow.
it's just like it's just so painful sometimes when you're trying to, you want to be aggressive, right, in this market to win deals, but I don't want to take people down the road and have them spend, not only have their earnest money at risk, but then also, 20, 30, $40,000 in third party reports and legal fees that end up, blowing up the deal. So our number one thing is execution certainty. So we're going to close the loan. So that's the last thing we want, is for you to go out, raise all this equity, raise your $1 million or $2 million, and then have to return all that money and have to lose all this earnest money because you couldn't get the deal closed.
Yes. Make sure that make sure to just to go straight to James before you go anywhere else. Really, that's what it comes down to, right?
That's what it comes
I thought
down
he'll
to.
save you all
That's
the
right.
headaches, right? I know we're pretty hot in this current state of the market, right? In Texas and nationally. Can you tell us where do you foresee the market to be at here in the next 6 to 12 months? Do you see it being hot?
Okay.
Going to be hot the way it is, or do you see it maybe dip a little bit or cool off a little bit? What do you see?
Yeah, let me speak to. I mean, I think what I'm seeing here in Dallas Fort Worth, just because the amount of transactions that we see here, in the last 2 months, so really starting sort of mid-January, there was probably over 30 multifamily deals listed in DFW. Okay, and interest rates on the 10-year Treasury went from essentially 2.5 all the way up to 290 or so. So 40 basis points increase. And in that 30-day span, nobody's rent went up that much. So,
Wow.
people put deals on the market and they were underwriting, interest rates of 4.5 to 4.75 in that range. And now all the offers are due essentially now here in March of 18, and almost nobody is at 80% leverage here in DFW. And so a lot of deals now, where you would have bidded $5 million because you could have got $4 million in debt, your bid now is like 4.5, right? Because your loan is 3.5 or even less than that. And so it's closer to that 75 number, or even 70 to 75% leverage on deals. And so we're really going to see, I think, the demand is still there. So, I mean, like, we have best and final here in an hour on a deal that's, a $6 million deal here in DFW. And there was, still 15 offers on the deal.
Oh, wow.
And, best and final, you think it's like one or two guys, it's like 6 guys in best and final. So, we're having, the demand is still there. I don't think sellers are getting as much on price as they thought when they released the deal in, December or January, because these interest rates, I think buyers are saying, well, how can I pay, a 5.5 cap on when my debt is 5.25? Like,
Yeah.
that spread
There's,
between your debt and
there's,
cap rate is
yeah.
getting very, very thin. And so people are either having to take lower leverage on deals, or they're having to pay less. And so there's got to be some give and take, but definitely on assets in strong locations. I mean, people still believe in sort of the affordability space and sort of B and C multifamily, especially in metros where there's population growth and job growth. So sort of your 4 markets in Texas, I think, are still very strong, and I want to buy everything that I can buy. So
So speaking of these markets in Texas,
Yeah.
I know Dallas is here in the last few years has been has probably been the leader in the multifamily space. Where do you see the other three markets, the other major three markets like Austin, San Antonio, and Houston? Where do you see those right now, and where do you see those going in here in the next 12 months or so?
So let's start with Houston. So Houston, definitely, similar size to Dallas. Um, the weird thing about Houston is that it does have, your concentration of oil. So that gives hesitancy to lenders. So Fannie Mae, for example, instead of being, 80%, they're 65 to 70% in Houston. And so that is a huge differentiator in lending in that market. So what I'm seeing is, um, to me, to invest in Houston, I need to see a discount to what I'm buying in Dallas. Okay, so if I'm buying a B class property in a good suburb of Dallas, let's say I'm paying 100 a door. Okay, um, if I go down to Houston, I want to pay 80 a door or 75 a door. So I want to see that discount, and I think it's still worth it to be investing in Houston. Um, the other thing that the whole Harvey sitting over Houston for 60 hours or whatever it was, pouring rain on Houston, uh, is insurance in that market. And so I just saw a deal that came across my desk, and essentially in DFW, in a non floodplain property, we're at 300 a door on insurance. On this deal in Houston, it wasn't a floodplain. They were underwriting close to 850 a door in insurance, and that is just a guess.
Wow. Yeah.
And so that's almost 3 times the cost for in Houston, similar product, 1970s product, 3 times the cost for that insurance coverage, and nobody knows what the cost of insurance is going to be in the next couple of years. So, um,
There's a lot of guessing right now. Really, nobody knows. Just like you said, for it to be more attractive, you basically have to be able to purchase at a much lower price per door, and otherwise, it's going to be a little bit risky. But at the same time, I do think there's opportunity for a lot of guys that aren't necessarily so high on Houston. There's going to be opportunities for guys to kind of sneak in, and while everybody else is kind of shying away. Do you agree on that?
Agreed. So, as I said earlier, a lot of the deals that I'm invested in are here in DFW, and I can sleep at night pretty well because I know they're not going to flood,
So you've
and
got a
there's not a
bait.
huge employer concentration. But I do, yeah, I'm definitely open to investing in deals in Houston, and I think deals in Houston make sense at a discount. And I would prefer, if they haven't flooded in the last 3 years, then to me it will not flood.
Before that, I mean, when was the last time things like that got that bad? It was forever. I mean, so what do you think about San Antonio and Austin? Like, what do you think about those markets and how they're doing?
So I like so San Antonio. I definitely think is more a B and C market. I mean, so I'm invested in sort of A minus deal there, and we have not been able to push rents as much as we thought in that market. So San Antonio, out of the four metros, has probably the lowest cost in terms of single family. And so once you're in that A market, you're seeing a lot of people jumping over the single family. And so just to give you an example on rents, this is a Class A property in sort of Northwest San Antonio, and we're our rents are maybe $1.25 to $1.30 a foot. Okay, and here in DFW, that would be like a B plus in a good neighborhood, and we cannot push rents past that number. And so I think in San Antonio, I'd rather be in the B space, taking rents from maybe $1 to $1.15. That makes sense to me in San Antonio. And I mean, I think what I forgot to mention in Houston, the upside in Houston as well is that there is absolutely no new supply coming in online in the next 2 years or 3 years in Houston. And so, and people are still moving to Houston, right? So you might have 60,000 jobs created, which is going to lead to 20,000 new households every year, and there's going to be like 5,000 apartments. So a lot of our deals are DFW, Houston, and San Antonio. We have not had many people buying in Austin just because of the price per door, and the cap rates in Austin have been excruciatingly high prices and very low cap rates, and just not being able to pencil a lot of deals. Most of our guys are buying deals for cash flow and not just appreciation. So so a lot of deals in Austin just have not penciled well, and you're starting to see negative rent growth in Austin. So
that's starting to come around now.
Yeah.
Okay.
That's,
So
negative rent growth.
who are the guys that are buying these deals in Austin? Is it more like out of state capital, or is it like out of country, or what do you see there?
I don't have a good answer for that. I mean, I think a lot of people are doing. I mean, it really comes back down to. I mean, you can buy these deals, but instead of 75 or 80% leverage in Austin, you might be at 60 to 65%. And so you're putting, let's say you have a 1031 out of California, you're putting down 35% on the deal, and your cash on cash is 5 to 6% instead of someone else's, 8 to 10. And so people are willing to accept that return. They like Austin. They like living in Austin. They, they understand the story there and want to be a part of it. And Austin's population when I went to school there was, probably 1 million, and now it's 2 million, and people think it's going to go to 4. So I think
it's definitely growing.
Yeah,
it's definitely growing. It's definitely a nice area for sure.
Yeah.
Let's shift gears a little bit and let's talk about the tax laws, the new tax laws. We had some, that changed back in last year, 2017, a couple months ago. Did those tax laws affect the lending side of it for like the multifamily guys, multifamily investors?
I mean, I think I like to sort of use sort of like a flow chart here. So, the new tax law, the biggest change in the tax law was really the corporate tax rates. So once the corporate tax rates came down, everybody is sort of expecting inflation in the near term, right? So it's going to create more spending. It's going to lead to higher inflation, and those higher inflation expectations are driving the 10-year Treasury up. And so, with the 10-year Treasury going up, that directly impacts Fannie Mae and Freddie Mac loans, and so those interest rates are going up, which has decreased the leverage on transactions. So that's sort of the series of steps that you have to go through to understand how the tax rate impacted the overall lending environment. But so that happened very quickly, right? So as soon as the tax laws were passed, I think, I was in Florida in December, sort of winter break, and, I was reading up on everything about this tax law, and it was all good for commercial real estate investors. And I mean, in terms of 1031 exchange, in terms of depreciation, in terms of, I think the other thing was around sort of your pass-through entities, everything was good, right? And so, I mean, I think in the short term, interest rates going up is hurting, commercial real estate investors because the debt is more expensive. But the overall effects of the tax law is going to increase the amount of money that corporations have, and that's going to increase the amount of money that individuals have at the personal level. So that's going to increase, wage growth. It's going to increase the amount that people can spend on rent. And so I think it will improve, rent growth in the next couple of years as more and more people get higher paying jobs and can move into nicer apartments. So
great answers. I love that. Okay, well, now we're going to get into our nuggets of wealth. These are questions that I ask every guest, and hopefully they can help out the listeners. What key tip would you give those multifamily investors who are looking to scale up and to a bigger level?
What key tip? Okay. I mean, I would say probably is to, number one, have a mentor. So that can either be someone formal or someone informal. And there's plenty of people who have done what you want to do. It's just figuring out the right path and find someone who's done what you want to do in the multifamily space, either in your market or outside of your market, because this is really a relationship business. And the more people you know, the more deals you'll see, and the higher probability that you'll be successful in this business.
Got it. I love that answer. What is one key tool, source, or platform that you use frequently that can also help others?
So I was thinking about this, and the best sort of free tool that I use, it's called New York Times Census Map. And what they do is take the census data and put it on an actual map. And it has income data, demographic data, housing data, and it's all, you can see it on a map. And so most real estate guys love maps. And so it's a lot easier to see trends on a map compared to looking at Excel spreadsheets with census data. So a lot of, like, almost every broker's package has demographic data, 1, 3, 5 mile radius. None of that even really matters. You have to look at the actual data on what is impacting, like you could be on the wrong side of the highway, but your 1, 3, 5 mile demographics are great, right? You need to look at the actual, what demographics are close to your property, and then, what the trend is going back historically. So you can see sort of in Dallas, Fort Worth, and sort of the major markets that I grew up in, I don't really need that as much because you see it day in and day out. But for somebody just entering a market, right? So let's say somebody they're in California and they want to buy in Dallas or they want to buy in Houston, like going to that New York Times Census Map and just looking at that map and understanding what the trends are. Like 10 years ago when I was buying a house, that would have been, I would have learned so much more just looking at that map for 5 minutes than I did, living in Houston for 20 years. Like it's pretty amazing.
Yeah. So what is the name of that again?
So if you just type into Google New York Times, so like the newspaper New York Times Census Map, and so then they have different versions.
Okay.
Census Map, and then you can sort data, sort maps by demographics or income or housing, and then it's for the entire U.S. And so if you're new to a market, that's a great way to get a snapshot of the demographics of that market and figure out where you want to be investing.
Great. And you said this tool is free as well?
It's free. Yeah, it's
Awesome.
It's online. It's free. No problem. Yeah.
Okay. Well, that's even better. Okay. Well, yeah, guys, definitely check that out if you want to look at a different market, or even if your own backyard, check it out. And I'm sure you guys will get a lot of value from that. What book are you currently reading?
Right now, I'm reading. I usually read like 7 books at a time, and wow. So it's I usually have like
all 7 books open at the same time.
Yes, I have like 2 audiobooks going and a couple. I'm trying to think what the last book or the current business book that I read. I mean, the last book that I got a lot out of was probably Tribe of Mentors. So okay. Tim Ferriss's latest book, he basically asked, 10 of the same questions to his, sort of informal board of directors. So guys that, are across multiple disciplines. And he asked questions that were very poignant and sort of action oriented. And so I like that, one night you could read about a general, the next night you could read about, a sports star, like it just varied. But then the common themes between all of them on things that you can implement in your daily life, I thought was really powerful. So it gave me that book, one of the questions was what books you read. And, so now I have like 20 new books after reading that book. So it's a good one. So I like that one.
Okay. Travel Mentors, guys, check that out. Check that one out. That's definitely a book I need to pick up as well. I have I have one of his other books, 4 Hour Workweek.
Absolutely.
Wasn't that his? I think that was.
Yeah, 4 Hour Workweek was, so that was definitely more about systems and setting up your business in a way that can run without you, in essence. So I think there's a lot of takeaways from that. Yeah, there's a lot of takeaways from that you can apply to real estate as well. And I think one of the great things about being a limited partner in deals sometimes is you're leveraging other people's time, and you're putting your money into transactions and earning a return off of that versus just your time.
Yeah, and then so it allows you to open up seven different books and then kind of have your eyes all over the place and read them all at the same time.
Yeah.
So, what do you believe is an investor's biggest fear or obstacle in real estate in general? What can they do to overcome it?
So I think to me, it's sort of, I don't know if you're familiar with Del Walmsley's their lifestyles in Houston. I mean, I think, rule number one is you can't lose your principal, right? So you can't lose the amount of money that you invest, right? And so I think for the first 10 years of my life investing, it was just, 401ks and Roth IRAs. And I never realized that, you can lose principal in the stock market, right? When the market goes down, I never realized that there was a way to actually protect yourself and invest in deals that you don't lose principal, right? So you understand that, all right, the property is worth $5 million today, but we're going to increase rents and lower expenses and drive NOI growth, and that's going to increase the value of this property. And it's so funny, like the last 3, 4, or 5 years, people are complaining about doubling their money in like 3 years, right? It's like people forgot that you could actually lose money in deals, and the market's been doing so well. And so I think that's the biggest fear is, when I invest in deals, I don't want to lose my principal. You've worked hard for that money to invest. And so, a couple things that I like, that are sort of my rules of thumb, I would say is, I like having cash flow from day one. So even if it's, 3, 4, 5%, I like having cash flow day one that's sort of paying me as I wait while you rehab or implement your business plan. I like deals that qualify for long-term debt, so I don't have to worry about the debt increasing too much on me, with a floating rate debt. And then I also like to make sure that, it can pay for third-party property management. So I think the smallest deal that I've invested in is probably 150 units. And so, the management fee on that is typically, 3.5% to 4%. And then, I like to raise all the rehab money up front. So if you're going to do $3,000 a door, I want you to either have it in a loan or raise it out of equity and get it done in the first 12 to 18 months. And then I really like to be in primary markets. So I'm not trying to hit home runs as an investor. I'm trying to hit singles and doubles. And so I'm typically, all my investments have been in sort of the major four markets in Texas.
Got it. I love that. Love that. Those are definitely some key things that other guys can also look into and kind of follow your steps there as well. Where can Commit to Wealth Nation go to find out more about you and contact you if they need to reach you?
Sure. The best is email. So my email is jeng@oldcapitallending.com. So jeng@oldcapitallending.com, or you can reach me on my phone, 214-300-5035. And then if you just type my name in, James Eng, ENG, on Google, I have, a bunch of articles and LinkedIn and all that type of stuff that you can find me as well.
Got it. So guys, definitely connect with him if you guys are thinking about getting into multifamily, and if you guys need some help with the multifamily underwriting side of it for the lending, please reach out to him and check him out. He's been there, done it. So as an investor, as a lender, so definitely check him out. James, I appreciate you being on the show. I appreciate your time and all the value that you shared with my listeners, and I hope you continue your success.
All right. Thanks a lot, Juan.
All right. Appreciate it.